Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm a managing principal and one of the portfolio managers at T2 Asset Management. This video is a quick overview, but should you want more information on the models I manage, please call me or send me an email and I'll be sure to follow up with you. Before we get started, just a quick reminder, this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers at T2 Asset Management. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, let's jump right into the numbers here. July turned out to be a really good month for stocks. As you can see, the S&P 500 and the Dow Jones Industrial Average had really nice gains in July, but it appears that the Dow Jones is still lagging a little bit on a year-to-date basis against the S&P 500. While small cap stocks, as reflected by the Russell 2000, underperformed large caps in July, they're still significantly outperforming for the year. The real struggle continues to be for the bond market, where we can see long-term treasuries adding losses in July and remain underwater for the year. Turning to sectors in the stock market, sector performance was very good as well. We saw healthcare, industrials, financials all do really, really well in July. And while staples are still negative for the year, they did rebound quite nicely from their May lows, which is when I added some position in staples. It appeared that at the time in May, staples were very oversold, and I took the opportunity to buy some, and it worked out well for us. At the time of this video, I no longer own them, but I do still have an overweight to small caps, mid caps, and technology. Now, I know many people have exposure to bonds, and I think it's important to understand that bonds can be very complicated, and they don't all perform the same. This chart here shows 5 different ETFs that are bond-related, and as you can see, the 2 on the left are negative for the year, while the 3 on the right are positive for the year. The 2 on the left there I have avoided. Those are high-quality, longer duration assets. The first one there is the broad aggregate bond index, and then the second one there, the larger losses, is the long-term treasury position. I did hold the 3 positions on the right, which reflect my appetite or my desire to hold credit risk over interest rate risk. And so those have been very good for us, and they've added to performance for the year, in particular for the accounts that we have that are balanced. Just remember, you really need to do your homework when it comes to bonds and understand the different sectors of the bond market so you can better allocate your money. This is one area that we spend a great deal of time on, and I think it's important for investors to make sure they're aware of the different sectors. Okay, so turning to my car analogy here, just like a car needs an engine, a transmission, gas, and tires to get from point A to point B, you really need to know how each of these components are related to the investment landscape in order for you to make progress. So let's take a look at our car here real quick. The economy, second quarter GDP came in at 4.1%, and the Atlanta Fed estimates GDP growth for the third quarter to come in at about 4.3%. These are just awesome numbers, indicating that the economy is doing very well. And if you look at the employment picture, job growth is still strong. Layoffs are trending to multi-decade lows. All of this is good news, and therefore I'm very positive on the economy. Earnings, second quarter reported earnings are excellent. The earnings came in with growth over 24%. Companies are beating both earnings and sales estimates, and as I've said in the past, as long as earnings come in strong, valuations are justified, and therefore I'm staying positive on earnings. Speaking of valuations, stocks are still holding at their 5-year average, and bond spreads are still on the tighter side. But because of the pressure on the 10-year Treasury to creep up to that 3% level, I'm still staying relatively neutral on valuations. And then finally, the markets are doing well. All the talk about trade wars seem to have had little impact on the markets. Volatility is still low. Stocks are doing much better than bonds, and the yield curve did steepen in the second half of July. And even though the yield curve is still on the flatter side, much more than I would like, I'm still positive on the markets. So what do we do now? Not much has changed from my last month's commentary. I still like stocks over bonds. I like the U.S. over international, especially given all the currency issues around the world. I do like small and mid caps over large caps, given their limited exposure to global revenues. On the bond side, I want to own shorter duration assets in the form of floating rate bonds over fixed rate bonds, as well as credit risk over interest rate risk. We've talked about the pain felt in the treasury market, so investors really need to be paying attention to the kind of bond risk that they're really holding inside their portfolios. And finally, hold diversified, low-cost, broad-based exposure to all asset classes. Studies have shown that 80 to 90% of your investment returns are going to come from asset allocation and not from stock picking. So I hope this video was helpful. And remember, if you want more information on specific models I manage, I'd love to hear from you. Thanks again for watching, and we'll see you next month.